The Federal Reserve has raised interest rates yet again. Borrowing money will cost you another 1/4%. This marks the 10th consecutive time the Federal Reserve raised interest rates. And with interest rates going up again in an attempt to slow inflation, what does the Federal Reserve's action on these rates actually mean for you? Newswatch 16's John Meyer looks at one of the big impacts: credit card debt.
So we hear a lot about interest rates going up, but it can sound like a lot of blah, 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 blah. Does it really have an impact on you? Well, if you carry a credit card balance, it does. Let's take a look at why. First, these are the interest rates in the past 4 years. Right now, the average rate across the country, 20%. You can see it was down around 14.5% the past few years. So what does that mean for you? Well, say you were carrying a $6,000 credit card balance. That's the average across the country for a household. At 20% interest, that current interest, and a $125 a month payment, it's going to take you 98 months, 8 years to pay it off, and you're going to pay $6,100 in interest, more than the balance itself. Let's look at what it would have been the past few years if it was at 14%. So now at that $125 payment, 73 months to pay off, 6 years, and $3,000 in interest. So boiling it down, what does that mean? So the change in interest rates means 20% versus 14.5%, 2 more years of payments, $3,143 more in interest on a $6,000 balance. You see, that's a big difference. Of course, this is just one scenario. And a lot of people that have a balance, they keep adding to it, or they can pay more or less. So it's a big difference in the scenarios, but it all means one thing. These higher interest rates, if you carry a balance, you are paying quite a bit more. John Meyer, Newswatch 16.